Welcome, everyone. I have the distinct pleasure of having Ian with us here to actually go through his framework on investing in stocks, his learnings, and help us all become better investors. And real quick, let me just share also my screen here. Ian and I have known each other for 2 years now, and I've always admired his decision-making framework. So I thought, hey, I reached out. I'm like, hey, do you want to do a conversation? He's like, yeah, that would sound great. So we started ideating on this masterclass. A little bit about Zillion. I have built a platform to help everyone reach financial freedom sooner. We have products to help improve your 401k, to track your budget and all your goals, to figure out if it's a good time to buy a house or keep renting, to how much to save for emergencies during a tumultuous time like today when layoffs are happening, how to pick investments and accelerate your journey, how to optimize your investments, and more than that, also money score. We all know our credit score, but credit score is actually 10% of your financial life. Money score is the rest 90%. So make sure you get it. Go to zillion.ai and get your money score. So we build all these products. Our goal is by spending less than 10 minutes a week, you should be able to get on a path to financial freedom. That's our goal. That's our promise. If you have any questions about it, happy to answer towards the end. And with that, over to Ian.
Hey, everybody. I'm Ian Seybold. And I just wanted to walk everyone through sort of my investing journey to start off. The first thing I'll say is just I'm not accredited investor or a fiduciary or anything like that. So just take everything I say with a grain of salt. But my journey started I started to come into money at my job. I work for an industrial company as a VP of finance. So when I got promoted into this role, I started to make a lot more money than I was spending. I didn't know entirely what to do with it. So I wanted to really start diving into investing. So my first step was to read a lot of books on the topic, and you see things all over the place in the books. So I read everything, started to decide, okay, what do I want to do? I was tempted by stock picking, but I didn't want to fully commit. So I sort of went halfway in between, and investing half my money into S&P 500 and half into picking stocks and crypto. I used some of my financial skills from work and applied them to researching stocks. It's something I enjoy. I've always had the sort of a financial and entrepreneurial mind. So I've always really liked business. And so diving into the different way all these different businesses work is really interesting to me. When I started to do that, I got pretty interested in tech stocks, just because the economics of tech are really crazy. It's very, very upfront costs, and then the marginal costs are extremely low to nothing, which can lead to some very crazy financial results. So I was used to seeing the financials of an industrial company, and then all of a sudden I dive into these tech stocks and it's a whole different world. And it really interested me, just the difference between the two of them.
And real quick, piggybacking on that, Ian, I worked in manufacturing as well, and then in software. In manufacturing, if you have double-digit, margins, say 20% margin, it's considered really good. In software, you start with 90% margin. Like that's your starting point. Most software companies, they have 95% margins. So gross margins are just crazy in software. So thank you for highlighting that.
Yeah, absolutely. And the offset to that gross margin is a lot of time you have a lot of OpEx up front, but as you continue to grow your sales, hopefully your OpEx doesn't grow at the same rate. So it's a really interesting business tech overall, and I've really dived into that. But what I saw was my stock picking quickly outpaced my S&P 500 growth, but you would see significantly more volatility. And I think this is something that is true across a lot of people. When you do get into stock picking, you are introducing a lot more potential upside, but with that potential upside comes a lot more volatility. And so we'll talk about that a little bit later on, but we can dive into the next. So why invest in stocks? Historically, stocks have been one of the highest returning asset classes. We have a slide later on sort of comparing a few different of these asset classes, but stocks have historically returned a lot higher returns, even when you start considering the risk profile, things like that. It's cool to have partial ownership in companies as well. You can start to have ownership. That's really what owning a stock is you have a part ownership of that company. And that's where you see some of the crazy things start to happen. For individual investors, it will never happen, but you'll see takeovers where people just buy stock on the open market and start to take over companies. So it's a really interesting idea. So you essentially have a claim to cash flows. How they pay those cash flows out can differ quite a bit. But it's a really cool idea. And then the other very nice things is it's easily accessible. You can do it essentially for free with all these different new apps that are out there, and it's highly liquid. So certain types of investments have very similar or higher returns, but they're not liquid. You cannot sell in and out of them very quickly. So that's one of the main benefits of stocks, is that there is a very wide market and you can easily enter and exit a stock in a matter of minutes.
And I'll just double click on one thing that Ian mentioned very eloquently, which is buying a stock means you're putting your money in some of the, if you think about it, public companies are some of the best run companies in the world, and they are able to hire the smartest people in the world. So when, let's say, I buy $10,000 worth of shares in Apple, I'm basically hiring people who work at Apple to do the job for me and grow my money. That's the way I've thought about it, is, like, let the best people do the things they do best. And by doing that, I'm letting my money grow handsomely.
Yeah. And then one of the other things I didn't put on there was just that when you invest in stocks, you learn a lot. So you learn a lot about business. So if you're an entrepreneur, studying different businesses can give you a lot of different ideas of the benefits and risks of it as well. So just to get an idea of how stocks compare, you can see a rough idea of the differences here of savings accounts return. 1% is actually even a really high estimate for savings accounts. So it's pretty crazy that the difference between that and the S&P 500 is a whole 9%. So you can see the 10-year returns, there's a huge amount of difference in there. And then you step down the line of savings accounts, CDs. Real estate is an interesting one. I know there was a separate masterclass on that. The benefit of real estate is really there's a lot of ability to get a lot of leverage in there. So 4% might seem low, but historically, that's a very, very accurate number. The benefit and where you see people really talking about real estate a lot is the impact leverage can have on that 4%. So if you are interested in that, I'd recommend checking out the previous Zillion masterclass on real estate. It really does help understand that investment type a little bit better. Bonds are a hot topic right now. Very interesting. Depending on interest rates, it can be a wide array of risk, but a lot of that risk is in the short term impact to interest rates. There's a lot of different types of bonds. Some of the safer bonds would be the US government bonds, but then you can buy individual company bonds as well. So there's a lot within that bonds bucket. But then you start to get into the stocks category of the S&P 500 and growth stocks. Very, very interesting asset types that I like to personally invest in, and that's really what we're focusing on. But you can see the returns are higher, but the volatility is also there. The risk is there. There is liquidity, which is nice and definitely helps offset some of that risk. But I don't think you can have a conversation about growth stocks without talking about risk, because what you'll see is as your returns go up in this chart, your risk goes up in this chart as well. And then venture capital is the sort of the ultimate end to all of that. Very, very high risk, high returns. So a lot of potential. Anything you want to add?
Yeah, one thing I would say is, and please ask questions. This is a good time to ask questions. Anything you have, concerns, questions about, this is the time to do it. But keep this in mind. A lot of people will tell you real estate is the best investment. I think it's great because especially you put 20%, banks put 80%. So your 4% return is multiplied by 5. So real estate actually gives you good results. But let's say you need the money in 2 weeks because you want to do something, XYZ, whatever it is. Real estate takes 6 months to liquidate the moment you decide. So your money is actually locked. So keep that in mind. Angela has a question. Angela, please.
Hi, thank you very much for this.
Yeah.
So I noticed that you've put for number 6 specifically growth stocks.
Yeah.
So that would mean that you'd have to be focusing on specifically those kind of companies. What would be, would you happen to know what the yearly returns look like if, you're just doing more generalized kind of stock picking rather than specific of growth stocks? Or is the point here to focus really on growth stocks?
So
Sure.
what I would say is that it would probably fall into that S&P 500
Okay.
box. And the point is not to really focus on growth stocks as much as lay out the framework that there is potential for higher risk stocks to have higher return. The S&P 500 would be considered lower risk, and a lot of times with that lower risk comes lower returns. And that's the important thing to remember about growth stocks, is that there is the high risk associated with it, because they're companies that are early in life, oftentimes growing sales very, very fast and losing money very fast. So anytime you're losing money, there's a lot of risk there, and a lot of growth stocks fall into that bucket.
And historically, small cap stocks have been considered growth stocks. I mean, so what I mean is typically a high growth company is typically smaller. Like Google is barely growing today, right? So Google is not a growth stock. Facebook is actually, their revenue declined in the last few quarters. So they're not a growth stock. Growth stocks are, I'll take an example, like Remitly. I have invested in that. Samsara, another company, Toast, Square. These companies are growing their revenue at 30, 40, 50% a year. So they are truly, and to Ian's point, they're losing money because they're investing everything back into the business. They're not going to pay any dividends. They're not probably going to do any stock buybacks. They just keep investing, hiring people, building more products. So and they are not going to be 100 billion typically. They'll be like maybe 10 billion-ish will be, the range, maybe 5 to 25 billion kind of range is when where you will find those.
Yeah, thanks so much, Ian and Gagan, for that. That's really very clear, and I loved the example. So thanks for that.
Absolutely. Great. Any other questions on this? This is a very busy slide, and there's a lot of information, but happy to answer any questions you might have. The whole idea is, whenever, a rule of thumb, if anyone is offering you more than 10% returns, this should be your baseline. If anyone offers you more than 10% and they don't tell you about volatility or liquidity or risk, they're not doing a service to you. They are probably, it could be a Ponzi scheme, right? Anyone offering you more than S&P 500, don't fall for it. It's very, very hard to beat S&P 500. And we will talk about it in this conversation, how you potentially can beat S&P 500. Okay, this is another thing. If you invest $100,000 in each of these 4 areas, you can imagine, and 20 years later, you can expect the money, for instance, growth stocks will become 1.5 million. Angel investing in totally illiquid startups could become up to 4 million. But cash will become only 155K. Real estate will become about 600K. And this is just to give you a visual idea. And this is a tool available on Zillion.ai. You can go and play around with it. But this gives you an idea of how the money will grow. The compounding really starts after like 7 to 10 years. And after that, it just takes off. Cool.
Yeah. And so we did just want to give an idea of sort of the different types of long-term investing you can do and give another view of sort of the different way you can view it. So all of these would be considered on a 10-year plus time horizon, which means you're going to hold it for 10 years, buy it, buy more of it, but never sell it. So stocks buy and hold. This is my favorite way. I think we'll talk about that a little later. It does take a little bit more work because you do need to know what you're buying. So we've put that down for 5 hours a week. And the thing you'll notice that annual returns we have in there is a lot of question marks, because that's really what this is. When you're picking individual stocks, you don't know what your return is going to be. When you're going into an all-weather fund, which is a mix of stocks, bonds, commodities, and cash, you have a very good idea based on historical trends of what your returns are going to be. When you're picking individual companies, it's crazy. You could get amazing returns or you could get terrible returns. It could go to 0, it could go to 100%. So the risk profile for that is long-term high, short-term high. But for that risk, you should be providing or returning a higher return. And you can see that in the S&P 500. Like we said before, that's really the comparison point for any stock picker is, are you beating the S&P 500? Because if you are not beating the S&P 500, you have to stop and sort of ask yourself, why am I spending so much time doing this? Should I be doing this? Can I just buy the S&P 500 and hold it? So it's sort of interesting when you look at the risk profile. In the short term, we said the risk is high, and that's because something like COVID, all of a sudden the S&P 500 took a 30% hit in a very, very short amount of time. But on a long-term time horizon, the large companies in the world are going to keep returning more and more financially. So I'd view that risk as low in the 10 years plus time frame. Because if you step back and look at it, there's not that many times historically it's happened. There's always opportunities for black swan events, things like that we couldn't predict. But overall, the longer you have on a time horizon for S&P 500, the shorter your risk is going to be. So I think it's important to remember that when you're looking at this kind of stuff, is understanding your time horizon and your risk profile. You have to put both of those together and then consider the returns you want to get and go from there. Any questions, anything you want to add, Gagan?
Yeah, and if you're wondering why we are emphasizing on S&P 500 so much, I think the simplest way to think about it is S&P 500 is a group of 500 companies that are probably the best of the best in the world. They are run by the smartest people in the world. They are run very efficiently. They can raise capital very efficiently, effectively. So the point is S&P 500 is a group of companies that dominate the world. And they keep dominating more and more. Like, 20 years ago, Apple was a small niche company, making niche products. Today, everybody wants an Apple product in the world. They have more than 1 billion devices all over. Everybody in the world, in every country, there is Google, there is Facebook. 500 companies keep growing, especially tech. And they're, Airbnb is going to be, is it already? I don't think so, but I think it will be pretty soon an S&P 500 constituent, because they are all over the world. Any questions? I know we have discussed a decent chunk of things. Feel free to ask any questions. And trust me, there is no silly question here. Whatever comes to your mind, please do not hesitate to ask. Okay. This one, Ian talked about the volatility. This is S&P 500 returns from 1950 till this year. And you can see 2022. So 2022 was a negative year. Then there was 2018. 2016 was a negative year. But you can see 2009 was really bad. S&P 500 is a roller coaster. This is exactly how the wooden roller coasters look like, right? It's up or down or up or down. And also, there is a saying in investing that stocks take escalators up and elevator down. You can see it. It takes many years for stocks to build some gains, and bam, in a month or 2 or 6 months, everything just vanishes. But we also say in investing, when in doubt, zoom out. Okay, so I did a little bit more number crunching. I'm like, okay, how do the 10-year rolling returns look like? So if you take average of last 10 years for every year, how do they look like? Well, now all of a sudden the roller coaster looks like a kiddie roller coaster. It's not a crazy one. How about if you zoom out even further, 30 years? It's actually a smooth road. If you invest today, doesn't matter which market you invest in, if you keep investing over time, in a 30-year time frame, you are expecting 10+% returns with S&P 500. That should be the benchmark. As Ian said a little while ago, if you can't beat S&P 500, you should just invest in it, not try to beat it. And we'll talk about how you potentially can. But keep in mind, 10% is the baseline. If your returns over the last however many years that you have been investing are not better than S&P 500, better than 10%, think again. And S&P 500, 30 years, always gives 10%.
Yeah. And then one thing that's probably worth adding here is when you step back and look at this, those spikes in the 1-year graph, if you tie yourself towards your investing returns, your net worth, anything like that, it's going to be a huge emotional swing. The psychology of money is really, really, really crazy, and it can mess with a lot of people. So really understanding that before you go in is really important to understand. Hey, zoom out. But emotionally, it's easy to say. But in practice, it's really hard to do. And sometimes coming back to a chart like this will really help you understand, okay, it feels wild right now. But if I zoom out 10 years from now, I'm not even going to remember this happened. And that's true for a lot of things in life. And it's definitely true for investing and stock picking as well. And then we just wanted to talk about the pros and cons, because like anything, there's pros and there's cons. So there's a potential for higher returns. A nice part is that you have control, you have flexibility. You feel that you are controlling your future a little bit. And it's a great learning opportunity, especially depending on the different industries you're in, your other interests. Stacking the skill of investing with other skills can make a very, very powerful combo. But there's definite risks to it as well. There's a significant time commitment. If you want to know what you own, a lot of times you have to stay on top of it. You have to study it. You have to listen to investors' calls. There's a lot of different stuff you have to do. And it does come with increased risk. And there are all these different requirements that you have to have the emotional intelligence not to sell when the market's going crazy. You have to have a certain level of financial understanding. I don't think you need a crazy amount. I think you can learn that pretty quick. Read a few books, watch a few YouTube videos. The secret of finance is none of it's not very complicated. Some people like to pretend it is, but it's really actually very simple stuff. And then you need some industry knowledge and you need some luck. Like anything else, there's good luck and there's bad luck, and it can go either way. And then I do like that Warren Buffett quote to understand that diversification may preserve wealth, but concentration builds wealth. And it's important to understand that. And it really comes back to the main idea I've been coming back to is risk versus return, understanding that profile when you go into something. We don't want to pretend like there's no risk here, because there's absolutely risk here. Anyone who promises you 10% returns or higher with no risk, like we said before, is probably lying to you. So keeping that in mind and understanding the give and take of those two things is very, very important to investing. And so when I'm diving in and actually looking at stocks, what I like to watch for growth stocks, it's price to sales. The general rule of thumb is it's tough when it starts getting over 10. Essentially, price to sales means you take a company's revenue and you compare that to the market cap and see what the difference is. And once you start getting into a very, very high number, you have to make some crazy financial projections in the future to justify that return. Because really, when you're doing a valuation, you just got to remember that you're putting money into the stock to get a claim of future cash flows. And when that stock is very, very highly valued, you need very, very high future cash flows to make that return. And price to earnings is very similar. The reason we use price to earnings a lot is because earnings are what you actually keep. It's what you take home. Price to sales is great. And it's great for growth stocks because their earnings are negative. So looking at price to earnings for a growth stock isn't super helpful. So you have to understand sort of the long-term profitability potential for that company and go from there when you're understanding price to sales. Unit economics is another really interesting one. Essentially what you're doing is you're looking at each individual sale for a company and understanding what impact that has. So for instance, you could look at a company like Netflix. Subscription companies, unit economics is great for, because you can step back and look at it and be like, okay, how many Netflix users sign up and then quit? So their churn's very low. I think the churn's in the low single digits, which is very, very good for the industry. But then you have to question, okay, how much do they have to pay in advertising to acquire those customers? How much monthly sales are they getting from their customers? What's their gross margin on that? And really understanding that financials is very important. But like I said before, it may seem a little intimidating at first, but finance is not complicated. People will tell you it is. I've been in the industry for 10 years. It's all very, very simple. You just got to step back and take it a little slowly, and everything sort of follows via common sense. You do need to understand some financials. Adjusted EBITDA is a very, very common metric people use, but be careful to pay attention to what is being adjusted. They call it adjusted for a reason, because the company is making decisions to say, our EBITDA is truly this by accounting standards. But if we adjust out all these random things, we're going to look a lot more profitable. You don't see companies adjusting down their profitability. It's only ever adjusting up. So understanding what goes into that number is important because that's what the companies tell you to look at. So understanding what goes into it, the adjustments can be crazy. That's the one thing I'll say. Free cash flow is another very important one. That's an accounting metric. Adjusted EBITDA is not a generally accepted accounting principle. So it's important to note that you can trust free cash flow a little bit more. There's a lot that goes into that number. So understanding what drives it is important. But essentially, that's the cash that's sort of left over after operations is the idea. And then one that I don't think a lot of investors think about is maintenance capital versus growth capital. So a huge important idea to understand is the capital intensity of an industry. So that's sort of the long-term investments companies make. And that is handled different accounting wise, but it's important to know that long-term projections for that capital can swing wildly depending what your maintenance capital is, which is essentially to keep your business going. How much in capital do you have to spend for new building, new vehicles, new servers, whatever your industry is, there's going to be a portion of maintenance capital. And then there's growth capital for, we're going to go get new business. And that's going to drive growth. Understanding that split is important, and it can be tough to find. And then finally, it's important to understand a company's moat. I think a little bit differently on this. A lot of companies say they have moats. I think most growth stocks don't have moats yet. And that's the important thing to note is that a lot of them are working on building it. There's definite exceptions to this. For instance, Tesla 7 or 8 years ago was a clear growth stock. And it definitely had a moat. It had an amazing brand. And that's really driven by Elon Musk overall. So there definitely are exceptions to that rule, but understanding that whether a company has a moat and then being honest about it, it's okay to invest in a company that doesn't have a moat, but you got to understand that brings higher risk. So that's really the idea of a moat, is that it's a long-term defense against competitors. So there's a lot of different kinds of moats. Brand, high switching costs essentially means it's tough to switch to competitors. Network effects means every additional user benefits the other users around them. And there's things like intangible assets, which are copyrights, things like that. So understanding if a company has a moat is very important going in.
Those were a lot of terms. And I can totally imagine you being like, okay, I need to know all of this. But we will talk about an easier framework towards the end on how you can actually identify stocks that might fit your investment style. So hold on, and we will talk about that. I think one thing I would say is, if something is publicly available, all of these things are publicly available. For instance, price to sales, NVIDIA's price to sale is right now 41. I would highly recommend not to invest in NVIDIA. It's $1 trillion company. Can it become a $10 trillion company? I doubt it. I seriously doubt it. But Facebook's price to sales is 5 or 6. Square's is 2. Shopify is 12. But we will talk about what all these mean and how you can fit all of this information into your own framework. So hang tight there.
Yeah, and just the final note on that, like not trying to overwhelm anybody with this. And really, when you step back and look at it, none of this is complicated. But if you look at it if you're just starting day one, it's going to be a lot. But if you start to look at it iteratively and understand, okay, what is price to sales? It's good. It's going to take you 30 minutes and you'll have a really good understanding of what price to sales means. So none of this is complicated. It's all common sense, but it is a lot of terminology. And then we just want to talk about best and worst decisions. So for me,
there's a question.
I just have a follow-up question on that.
Yeah.
You suggest, so obviously there are a couple, if we just go back to the slide, there are a couple of things to watch for. Do you recommend sticking to growth stocks in a particular sector? Like how, for example, how would I know maybe moats in manufacturing? I've never quite worked in manufacturing. I don't know how the industry, or are you suggesting that it's a more broad approach, but if you do pick sector, okay, I think we're going to get there, so I'm just going to stop my question.
No, I think it's maybe it's a good point to answer it right now. Everything that we talked about, right? I think that's a brilliant question, Angela. How would you know? I think this is the framework that has worked really well for me. It is what I do. So my work has been in tech for the last 15, 16 years, right? 18 years now. So I know tech really well, but I only know tech in the US where I live. I've lived in the Bay Area for 8+ years. I've lived in Boston before that. So I know tech in the US. But the third important factor is, what do I love? I actually love reading Wall Street Journal, New York Times, Economist, and just political news, geopolitical news, economic news, business news. That's just something I've been doing for 25, 30 years, right? Ever since I got access to a newspaper first time. And that's where the investing ideas came from. So my point is, if you don't know the moat of a manufacturing company because you don't know manufacturing, you know what? You don't need to invest in manufacturing. Find your own strength. In a way, find your own investing moat. You will have it if you actually look at the intersection of these three things. You will be able to identify, I would say, about 100 or 200 companies easily. Then you can double down on that and say, okay, which of these companies actually are likely to be, high growth over the long term? Does that answer the question?
Oh yeah, fantastic response to this. I'm probably going to steal this framework and just narrow down on areas where I, like you said, I have a moat and understanding just based on these three factors. So thanks so much for this framework.
Oh, absolutely. Absolutely. And please feel free to steal it, share it with others, because this is not patented. Absolutely. Any other questions? I know we went through a lot of dense information. Any other questions? Okay. Here we go.
And so just some of my best decisions for me, it's holding through volatility. It's buy and hold. That's my personal investing strategy. it's a little tough at times because volatility doesn't always feel great. But what I've seen is the winners have paid for the losers twice over. It might sound easy to hold, but watching your net worth swing wildly isn't for everyone. So it's understanding and feeling that. And sometimes it's starting with a small amount of money. If that's what you want to do, if you do want to try it out, start with a small amount of money and see how it feels when the market swings crazily, like it is, and it will continue. Understanding how that makes you feel is important to understanding if stock picking is right for you. And it really comes back to this idea I've been talking about this whole time, is understanding your risk tolerance. Risk versus reward is key.
Yeah. And one thing I suggest is, as Ian said, if you are just getting started, maybe put 10% of your liquid net worth into this, right? And rest keep in low cost index funds. 10%, if you lose it, it's not going to be the end of the world. But you will learn about it, how to go about investing. You will learn your own personal style. You will learn your strengths, your weaknesses. And if it interests you, maybe increase that from 10 to 20% over time and go forward. If you're like, you know what, it's not worth my time and hassle, forget it. Sell all that 10%, go back to low cost index funds. And also, here's another thing, right? S&P 500 is one thing. If you have a little more appetite for risk, you can invest in NASDAQ 100. Which is even more volatile, but NASDAQ 100 is highly concentrated in tech stocks. You can actually ride. If you think tech is going to do well over the next 20 years, you can buy NASDAQ 100 and ride the wave.
And then personally, some of the worst decisions I make is just when I step back, are the ones I knew. The decisions I knew not to do, and I did them anyways. So buying companies that are clearly not great operators. So you can step back and you can get an idea of how effective a company is. And there's a lot of, you can take a look and see COVID stocks, for instance. Peloton would be an example of one that really benefited from COVID. And then when all of a sudden those COVID impacts started to go away, turns out Peloton was swimming naked. They were not operating efficiently, and you could see that if you were looking closely. So I've made this mistake several times across different companies. I know it going in, but it's one of those things where when things are flowing, it's tough to be rational. And it really brings me back to the Stanley Druckenmiller quote. He's a very, very famous investor. And it's just very interesting because you don't have to read the whole thing. The idea is, you asked me what I learned. I didn't learn anything. I already knew that I wasn't supposed to do that. And this is true for me as well, where my worst decisions aren't the ones where I make a mistake. It's the ones where I knew it was a mistake going into it, and I knew not to do it, and I did it anyways. And I find this to be true for a lot of people. So it's important to remind yourself to level set before you go into making decisions and be like, okay, sometimes you have to sleep on it for a night. Sometimes you have to sleep on it for a week. But for me, those are the worst decisions. Those are the ones that hit me the hardest, is where going into it, I know it's a bad idea. And for some reason I do it.
Yeah, I'll give you an example. In year 2017, I had some cash, and I wanted to invest in a company that had declined in a value by like 97%. I'm like, if a stock declines, it should come back up. But it was a company it was a Greek shipping company. They literally had ships. And so what do I know about ships? Nothing, zero. So what did I do? I called my friend. He actually is a merchant navy engineer, as we call it, right? He fixes the ships. He is on the ships. He's like, listen, Greek shipping companies are frauds. They own the world of shipping, but there are more fraudulent companies than not. Don't invest. I'm like, what does he know, right? I invested. I lost swiftly, like within a month. I lost about 98%, 99% of that investment. Gone. Okay, so anytime I invest outside my core competence, I've lost. Last year, everything was dropping, and I was buying. And so I bought a lot, and I bought a lot of WeWork stock. I thought WeWork was a tech company. I thought WeWork has a great product. I use WeWork every day. Guess what? I don't know the commercial real estate industry. I have lost about 90% of my investment in WeWork. Again, whenever I go outside my sphere of competence, circle of competence, I end up falling on my face and not making any money, in fact losing most of it.
So, Gagan, maybe a question. So there's always this concept of fear of missing out, right? Like we think about larger or long-term investments, but you also want to ride the wave with smaller, like something example you gave for Peloton, right? It did rise at the time. So how do you curb, and what is your strategy towards such investments as well? And we see the trend, people making a lot more, exiting out in a year or two. And then, so how do you kind of, don't miss out on that? Or do you keep on playing a little more safer for a longer term? What's your thoughts on that?
So here's how I go about it, right? And I'll show you, maybe it's time to show this chart. This is actually my investing history. So one thing is, I'm not a trader, I'm an investor. I invest for the long term, okay? Along the way, you could see I have made some decent trades, but I've lost some money. And this is, like anytime I've lost money is negative. Anytime I've made money is positive. More pluses means I've made more money, more minuses, I've made lost more money. This is the shipping company I was talking about. But rather than the trends, I'll give you an example. I bought Facebook at IPO. At IPO, it was considered a dumb decision because there was a lot of hype and all that. And it crashed after IPO. When it crashed, I bought more. So when I'm trying to invest to ride waves, I'm trying to ride 7 to 10 year waves, not 1 to 2 year waves. I think 1 to 2 year waves are too crazy, too risky, and they're not waves, they are typically speculations. Like right now, we are in an AI hype cycle, right? 2 years ago, we were in a coin hype cycle. 2 years before that, we were in a social hype cycle. We get into hype cycles. My goal is not to ride a hype cycle, but to ride a long-term trend. When Facebook IPO'd, my thought was that so many people love this product. This was 2012, back when Facebook was actually loved as a product. I'm like, there is no way they cannot make money. They can make as much money as Google. And it turned out to be true. I invested in Tesla, which is kind of, I would say between Facebook and Tesla is where I've made most of my money, most of it. And as Warren Buffett says, you only have to get some decisions right, but invest in the long-term trends. You know what I mean? I was okay riding out. So for instance, I tried to, this is my history, I tried to ride the options during COVID, okay? This was my, brilliant attempt at buying options, call options, when the stocks were falling. And I lost more money than I made, net. Short-term trends are very, very hard. Long-term, you can easily spot based on your own strengths. So this is my long-term bets. These, like anything I bought last year, Toast, Square, Robinhood, Remitly, Doma, I'm not doing very well. Hippo, I'm not doing very well. Redfin, Teladoc, Fiverr, Freshworks, Samsara, WeWork, I'm not doing too well. But these are my long-term bets. I think these companies will do well. And to be more specific, like Toast, anytime I go to a restaurant, I see what terminal they use, and I talk to them. And anytime I talk to anyone who had Toast, they were very happy with it. So I'm like, okay, this is a trend. Restaurants have old terminals. Over the next 5 years, they're all going to replace, first in US, then outside US. So I invested in Toast. Turns out, I think in the next 10 years, this is going to become a 10x stock, in my opinion. Again, this is not investing advice, but in my opinion, Toast could be a big winner over the long term. Does that help?
Yeah, thank you for that. I think it does make sense. I think it's only that human instinct that you don't want to miss out when your friends are riding the smaller term waves. But then again, you need to look in a larger lens of like 10 years down the line rather than short-term hype cycles, as you mentioned.
Yeah. Also, human psychology. People will talk about their winners more than their losers. Anyone who's telling you they rode this wave and they made $15,000 in profit, they're probably hiding another $10,000 in losses that they're not telling you. So, yeah, don't worry about that.
Thanks.
Okay.
Yeah.
I think we have very little time, and maybe we can zip through, and please keep the questions coming.
Yeah, I can go. And so essentially, it's just important to understand diversification and concentration, the benefits and risks of that. Concentration can build wealth quickly. Diversification can preserve wealth. Understanding that is pretty important. We can dive into the next one.
Yeah, and real quick, if you own 10 stocks, your risk is similar as S&P 500. I learned this in business school. I spent $160,000 to learn it. You're getting it for free.
Yep.
10 stocks or more, as long as it's not like, if you're buying, let's say Facebook and Twitter is not there, but Facebook and Pinterest, they are highly correlated. They don't count. But if you own, a Facebook and an Apple and let's say, 3M and all that, if you have 10 non-correlated stocks, your risk is same as S&P 500. So you can be concentrated, but with less risk as
well. And then just really quick, there's some tools for investing. A lot of this is free. Koifin is a good financial platform that lets you see financial information. Finviz is very nice for stock screeners. So if you are having trouble finding stocks you want, or you want to find in certain industries, Koifin's great for that. Finviz is great for that. Whale Wisdom is interesting. It's for finding stock ideas via 13Fs. So essentially, Warren Buffett has to publicly state what he's invested in. All the great investors who run these funds, they have to publicly state it. So it's a great way to get ideas. Then books, podcasts, newsletters, all very helpful. And those are some of the ones I like.
And we will be sharing this, so you don't need to note anything down. We'll be sharing the presentation at the end of this.
And then just really quick, how to find investments. There's a great Peter Lynch quote that really overlaps with the framework that was shown before. Invest in what you know. If you love Apple products, start to dive in, see if that's interesting to you. If you love Cash App, see if Square is the right company for you. If you love using Pinterest, maybe Pinterest is a good investment for you. A lot of times you can dive into that, you know it well, you know its strengths and weaknesses, and you can go from there. Stock screeners, like I said before, social media is interesting, but be careful not to fall into the echo chamber. It's easy, like we were talking about before, to buy Tesla at the top and sell it at the bottom. Because when it was at the bottom and where the great returns were, a lot of people hated it as an investment. So social media is good for ideas, but you got to be careful with it as well. And then scrubbing 13Fs, like I said before, those are some of my personal favorite. A lot of great investors. It's easy to step back and look and see what they're owning.
Yeah, this is Berkshire's Warren Buffett. He said he has made about a dozen good decisions over 60 years. That means one every 5 years. And this is a guy who reads financial statements as pastime, right? That's his thing. So you and I cannot expect to make every decision, like every investing decision cannot be good, even when Warren Buffett cannot make a good one every so often. So he picks more losers than winners, right? Even Warren Buffett. But the winners pay for the losers. And that's my case as well. So if you have some losers in your portfolio, that's okay. That's part of the deal. Even Warren Buffett has losers. This is my, as I said, I've lost a lot of money. I've made most of my money until now in Tesla and Facebook and Square. And my guess is last year I doubled down on these companies when the market was crashing. And I'm hoping this is going to provide the next kind of impetus. This again, invest in what you love. And one thing that, Ian said, and I'm going to deep dive on this a little bit more. If you love Apple products, keep in mind, there are a billion other people who love Apple products. You may not have any edge, but let's say there is a small company that recently went public. They came up with a product and you happen to know this product because you used it at your work, or you used it at your gym, or your friend showed it to you. Now that is unique. Maybe a few thousand people know about it and nobody's really excited about it. Banks have not started covering that stock. That's your opportunity, and that's where I have seen my opportunity, right? like when I invested in Facebook, no one really wanted to invest in Facebook. Their stock was crashing. When I invested in Tesla, Tesla had not shipped their first car yet when I invested in Tesla, right? So keep in mind that the best, you investing in Google, evaluating whether to invest in Google or Facebook, everybody knows you may not have an edge. If you want to invest in Apple or Google or Nvidia, or even Tesla now, it's better to invest in S&P 500 or NASDAQ 100. Find your own niche strength that you have based on where you work, what you use at home, maybe your kids use something, blah, 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 right? Find your niche. And we also help you. We have some tools in Zillion. We help you with P2S, price to sales ratio. We also help you, like Ian owns Shopify. He's a big proponent of Shopify. And we give you tools to really narrow it down. If you're looking for ideas, like you may never have heard of Amplitude, but if you look at it, you're like, okay, the price to sales ratio is not bad. They're in tech sector. Maybe you want to explore them a little bit. So you can come to Zillion and see for yourself some of the growth stock ideas in action. Okay, and you can get your 1 month free trial today on zillionapp.com. We are at the end of the presentation. We have a few minutes. Please ask any questions you might have. Happy to answer any and all questions. There are no silly questions, no bad questions. Please ask away. Also, if you go to Zillion, you can see my portfolio real time, Ian's portfolio real time. So, we share it. Every week you will see a snapshot of what we own, how much we own, and so forth. So you will get that as well. And if you,
I have a question.
Yes, please.
Regarding Zillion. So would you call it more of a social investing app like Public, eToro, but with a little bit more of analysis? Is that how you describe it?
Our goal is to be your financial partner in the sense that help you make better financial decisions. eToro and Public and those, they only focus on stock investing. We actually help you make good decisions about stocks, about 401k, about real estate, about angel investing, about buying a house, all of that, real estate investing. So we are broader than that. The idea is to be your personal financial advisor.
Okay. And so I'm based out of Canada. Would you think that this would be applicable, or would you say it's mostly for US-based investors?
So right now we are focused on US-based customers, but my guess is you can still utilize some of the tools. Okay. Because no matter where you are, American stocks are the most liquid and the biggest names out there. So you can still utilize the tools for sure.
Yeah. Thanks for that.
Any other questions?
So we talked about some of those financial principles like price to earnings, price to sales. How do you keep track of it? Do you kind of listen in on the quarterly results for the interested stocks, or how much of a time investment it is? Because I guess many of us would have other full-time jobs, and how do you always stay intact and with up-to-date knowledge on that?
Yeah, so for me personally, I'm listening to the quarterly earnings, and then I'm using something like Koifin to trend it. And then depending on how many stocks you have, you can do this in 5 hours a week or so, but it is tough. It's tough to give up 5 hours a week to dive into this stuff. But there are some nice tools on that tools that will help. Looking at Koifin will show you trends over time. You can do screeners on stocks, all that kind of stuff that really helps. But yeah, it's really looking at the financials and listening to the management conversations. And then sometimes you can do things like podcasts that help too. That's a little more, you can do it while you do other things, which helps.
Angela?
So my question is around rebalancing the portfolio. So Ian, specifically, you had mentioned that you're typically a buy and hold. So has there been ever a scenario in your portfolio where you bought a stock it's not doing that great, or maybe you're weighted in a specific area or sector that's maybe looking like it's in decline, how do you handle that, considering that you typically buy and hold? So you're not selling, you're not trading that often.
Yeah. So personally, when you do buy and hold, you'll find 2 or 3 stocks will take over your portfolio really quickly. So the way I deal with that is I'm careful where I allocate my new capital going into it, but I hold. So I'm not rebalancing between stocks. I understand there's definite benefits to doing it, and there's risk to doing that. But personally, the way I do it is where I deploy new capital, and I'm not actively selling my stocks until I'm looking to exit a position. It's just the way I handle it.
Yeah, and what I do is I actually rebalance about once a year. When I say rebalance, I, rather than trying to get a certain, like, hey, I want 30% tech and 20% manufacturing, what I evaluate every December is, are the stocks, the thesis that I had, are the stocks still within that thesis and adhere to that thesis or not? And do I still feel the same way? If not, then I just cut those stocks. Sometimes to take, for instance, when I bought Tesla in 2013, or Facebook in 2012, I said Facebook will be about a $300 to $400 billion company. When it reached $300 to $400 billion, I sold it. I said Tesla is going to be a $1 trillion company when I bought it. And over time, I'm like, okay, it is becoming $1 trillion. So I started selling it. And last year, I sold all my 401k funds and everything, index funds. And I bought the Remitleys and Samsaras and Toast and WeWork and so forth. So I do it once a year. It serves me well.
Thanks so much. I like seeing the contrasting kind of approaches to how you handle rebalancing. So that's very helpful for me. Thanks.
Absolutely. Maybe we have time for one more question.
Yeah, there's one in the chat.
How do you calculate the price to sales? Well, you don't need to calculate it. Actually, you can just go to, I'll share more tools, and we also have it in Zillion as well. You don't need to calculate. People have already done it. You just need to see the number. Just keep in mind, anything over 10 is a expensive stock. Anything less than 10 is less expensive stock. So more room for growth. If Snowflake is at 25. Is Snowflake going to grow that much? Probably not. But Square, Amos, hey, Amos and I were on the same team at Square. Square is at about 2 or 3. Facebook is at about 6. So you can get this data easily online. Any other questions? Great. Thank you so much, everyone. Thank you for asking great questions. It was a pleasure having you. And Ian, thank you so much for sharing your wisdom.
Yeah, thank you. Thanks, everyone.